Your bank account does not guarantee access to your money. Most people assume that if the balance is there, the money is available. But inside the modern banking system, access is never absolute. Because the ability to use money inside a bank account depends on rules that most people never see. And once you understand how those rules actually work, the idea of having full control over your money begins to look very different, because banks do not simply store money. They control the infrastructure through which money moves. This video examines a structural mechanism inside modern financial systems. A mechanism that has existed quietly for decades. One that determines when transactions are allowed, when accounts are reviewed, and when access to money can be interrupted. Not because something dramatic happened, but because the system itself has the authority to decide. The first misunderstanding begins with how people imagine a bank account works. Most people picture a bank as a place where their money sits, waiting until they decide to use it. A digital vault. A storage location for funds that belong entirely to them. But that image does not reflect the legal and structural reality of modern banking. When money is deposited into a bank, it does not remain stored for the customer. It becomes part of the bank's balance sheet. The bank records the deposit as a liability, meaning it owes that money back to the depositor. But the funds themselves are not held separately. They become part of the bank's resources, used for lending, used for financial markets, used for liquidity management across the financial system. In exchange, the depositor receives a claim. A claim that can normally be accessed whenever they request it. Normally. That word matters more than most people realize. Because the claim exists inside a system governed by rules. Rules that determine when access proceeds smoothly and when the system intervenes. Those rules are not optional. Banks operate inside regulatory frameworks that require constant monitoring of financial activity. Every account must be monitored for suspicious transactions. Every payment must be evaluated for compliance with financial laws. Every transfer must pass through layers of verification systems. These requirements were built gradually over decades, primarily to prevent financial crime, money laundering, fraud, terrorism financing. But the infrastructure built to enforce those rules created something else at the same time. A system capable of controlling access to money at the institutional level. Because the same monitoring systems that detect suspicious activity also possess the authority to interrupt transactions. And sometimes the authority to restrict accounts. This authority is not theoretical. It is written directly into the legal agreements that govern banking services. When someone opens a bank account, they agree to terms that allow the institution to delay or suspend transactions when necessary. Most people never read those agreements. They are long, technical, filled with legal language. But buried inside them is a simple principle. The bank can restrict access to the account if its systems determine that additional review is required. From the perspective of the financial institution, this authority is necessary. Banks are responsible for maintaining the integrity of the financial system. They must detect suspicious activity. They must respond quickly when risks appear. If they fail to do so, regulators impose severe penalties. So the system is designed to act cautiously. Sometimes very cautiously. The result is a financial infrastructure where every transaction passes through layers of automated evaluation before it is approved. When you use a debit card, the transaction travels through a network of institutions. The merchant's bank sends a request. A payment network routes the request. The issuing bank analyzes it. The bank's systems evaluate the transaction for risk signals. Balance verification, fraud detection, compliance screening. If the transaction passes these checks, it proceeds. If it does not, the system declines it. The account holder does not participate in that decision. The system makes it. This process happens so quickly that most people never notice it. But the authority behind it is always present. Every payment request asks the system for permission. And the system retains the ability to say no. Most of the time it does not. But the possibility exists inside every transaction. Which means access to money inside the banking system depends on institutional infrastructure. Infrastructure controlled by institutions. Over time, this structure has become even more powerful as banking has moved deeper into digital networks. Decades ago, cash provided an alternative. Physical currency could exist outside the banking system. A person could withdraw money and hold it independently of institutional infrastructure. Digital banking gradually reduced that possibility. Today, the majority of financial activity occurs electronically. Salaries are deposited digitally. Bills are paid electronically. Purchases are processed through card networks and mobile payment systems. The economy increasingly depends on digital financial infrastructure, and digital infrastructure requires oversight. Oversight means monitoring. Monitoring means authority. Authority means control. None of this appears dramatic during normal banking activity. The account works, payments clear. Balances remain accessible. But the underlying structure has quietly changed. Money no longer exists independently of the system managing it. It exists inside the system. And systems always retain the ability to control how they operate. Sometimes that control becomes visible. A payment suddenly declines. A transfer is delayed. An account is temporarily restricted. These moments often feel confusing to the person experiencing them. Because the account holder believes they control the money. But the system sees something different. It sees transactions flowing through an infrastructure designed to enforce rules. Rules that prioritize stability and compliance over individual convenience. The bank does not necessarily believe the account holder did something wrong. Often the restriction occurs simply because the system detected a pattern it cannot immediately explain. A transaction outside normal behavior. An international transfer that requires additional screening. A payment linked to an account already under investigation. The system responds cautiously. And caution sometimes means interruption. From the outside, this can appear arbitrary. But inside the system, the decision often reflects automated processes analyzing vast quantities of financial data. Algorithms compare the transaction against millions of others. If the pattern resembles known risk indicators, the system intervenes. The intervention may be temporary, but it reveals something deeper. Access to money inside the banking system is conditional. Conditional on the system's approval? This does not mean banks randomly remove access to accounts. In fact, such interventions are relatively rare compared to the enormous volume of transactions processed daily. But the authority to intervene exists within the structure of the system itself. And that authority becomes more significant as financial infrastructure becomes more centralized. Modern payment systems connect banks, regulators, and financial institutions through complex digital networks. Each transaction flows through this network. Each node evaluates the activity according to its own rules, fraud monitoring systems, compliance databases, liquidity management systems, regulatory reporting tools. The complexity of these systems makes financial infrastructure extremely efficient. But it also means decisions about financial access are distributed across layers of institutions, not controlled by the individual account holder. If you want to understand how these hidden financial mechanisms work before they affect you, consider subscribing. Because most people only begin noticing them after the system has already intervened in their account. The deeper issue is not whether banks should have the ability to monitor financial activity. In many cases, that ability protects people from fraud and financial crime. The deeper issue is how this monitoring changes the relationship between individuals and money. As financial systems become more digital, money becomes inseparable from the infrastructure managing it. And infrastructure always includes rules. Rules about how transactions are evaluated. Rules about when intervention occurs. Rules about what conditions must be met before money can move freely. These rules evolve gradually. Regulatory frameworks expand. Fraud detection systems improve. Monitoring algorithms become more sophisticated. Each improvement strengthens the system's ability to control financial flows. But those changes rarely attract public attention. They appear as technical upgrades, compliance improvements, security enhancements. Yet collectively, they reshape how money behaves inside the financial system. Money becomes something that exists within a network of permissions. Permissions granted by institutions operating the infrastructure. Most of the time, those permissions remain invisible. The system approves the transaction, the payment clears. Nothing unusual happens, but the approval was never automatic. It was always conditional. Conditional on rules embedded inside the system. Over time, this structure begins to redefine what access to money actually means. The account holder still sees their balance. The money still appears to belong to them. But the ability to move it depends on infrastructure that operates according to its own priorities. Stability, compliance, risk management. These priorities shape the decisions made by the system long before the account holder notices anything unusual. And when the system finally intervenes, the moment often feels sudden. But the authority to do so was present from the beginning, hidden inside the structure of modern banking. Accepted quietly when the account was opened. Maintained continuously by the infrastructure processing every transaction. The bank does not need to seize money to control access to it. It only needs control over the system that moves it. And in the modern financial system, that control already exists. Have you ever experienced a moment where your bank declined a payment, delayed a transfer, or restricted access to your account without clearly explaining why? Pinned comment suggestion. Have you ever had a transaction blocked or an account restricted without warning? I'm curious how common this actually is.